Emerging markets are entering the current period from a position of broadening and durable strength. In recent episodes of global risk aversion, EM sovereigns have demonstrated a structural shift. They now absorb volatility far more effectively than in previous cycles, underpinned by strengthened domestic policy frameworks that have significantly enhanced macroeconomic resilience. This internal progress has been complemented by a constructive external backdrop, moderating but still positive global growth, a Federal Reserve leaning more accommodative, and a softer US dollar. Historically, EMs were rather vulnerable to global shocks, facing sudden stop capital flows, sharp currency adjustments, inflation spikes, and difficult policy trade-offs. Over the past decade, however, many EMs have fortified their monetary, fiscal, and macroprudential frameworks. Inflation targeting regimes, more flexible exchange rate systems, reduced FX mismatches, and strengthened fiscal credibility now allow policymakers to absorb shocks with significantly less dislocation. Growth dynamics further reinforce this resilience. Amid trade wars, supply chains have adapted rather than fractured, and the trade flows have been rerouted, particularly across Asia, supporting diversification and competitiveness. The IMF projects emerging market economies to expand above 4%, meaningfully outpacing their developed market counterparts. Monetary easing should serve as an additional catalyst. Credibility gains and deeper institutional independence have improved policy transmission across major emerging market central banks. With inflation moderating, we anticipate further rate cut cycles in Brazil, Mexico, and South Africa. Favorable inflation trends and improving fundamentals also point to lower yields in sovereigns such as Uruguay, Uzbekistan, and Egypt. Credit dynamics are aligned with this constructive fundamental picture. Rating upgrades continue to outnumber downgrades, and the share of EM issuers rated investment grade has risen steadily. In previously stressed sovereigns, restructuring have advanced. IMF programs have anchored structural reforms, and the domestic markets now play an increasingly central role in sovereign financing. Within sovereign credit, several opportunities stand out. Ecuador and Argentina offer improving reform momentum, supported by strong political commitment under their IMF programs and bolstered by constructive bilateral relations with the United States. In Hungary, markets appear to discount the probability of a market-friendly election outcome in 2026. Suriname has mitigated key investor concerns through recent liability management operations. Ratings momentum remains firmly positive across Morocco, the Bahamas, Ivory Coast, and Nigeria. Looking ahead, emerging market sovereigns stand stronger, more resilient, and increasingly differentiated. An asset class transformed from high beta to high conviction.